Dear students, we were discussing about the capital budgeting, and we have assumed the value like we have two projects. Let's say that both the projects have a initial investment of $50,000, like a project A and project B, but the inflows are different. So the first techniques that we are going to discuss is the concept of what is the concept of the payback period. Now, the payback period means what? This company or this business is investing how much? 50,000. But this 50,000 is the outflow. Now, this is giving them the benefit in the next 4 years because the life of this asset or life of this machine or life of this project is how much? 4 years. So they are getting the benefit in the next 4 years. So now we have to decide that either project A is better or project B is better. So the payback period simply calculates that in how many years your initial investment will come back to the business. Like in the first year, what the net benefit in the form of the cash inflow that they're getting is 20,000. So in the payback period, what we have to calculate the cumulative inflow of the cash. Now the inflow, what we have to calculate, and it will be cumulative inflow. Cumulative means what? That in every year we are going to add that amount. So let's say it is a 20,000 what they are getting in the year one. It means still they have not achieved the 50,000. So the life of the asset, the payback period is more than 1 year. Now 20 plus 25,000. So it will be how much? It will be 45,000. It means what? That in the year one, what they have received back is 20,000. And in year two, it is a combination of year one and year two. It is how much? They have got 45,000. But still, they have not achieved the target of 50,000. Means the payback period is how much? Payback period is more than 2 years. But if we look at the value of the next year, so it is how much? It is 28,000. If we add this 45 and plus 28, so the value will be obviously above 50,000. But it means the time period, the payback period is how much? It is more than 2 years, but it is less than 3 years. So what we have to do? We have to find the fraction of that year. So it means how much extra we need. Simply, we have already calculated, we have already done how much we have received, how much inflow, the cumulative inflow 45,000. And what is the target? It is 50,000. It means you need 5,000 more out of what? Out of 28,000. So 5,000 divided by 28,000. So this is the year fraction. So it is year one, it is year two, and then it is how much? It will be almost like a 18%, or what you say, the 118. So this is 2.18 years. So this 2.18 is what is the payback period for this project. Means in the first year, the total receipt is how much? 20,000. In the 2 year, it is 45,000. But in the next year, obviously, it is more than 50,000. So we are finding that fraction, that how many extra months are required or how many extra days are required. So for this purpose, what we are doing is 5,000, and then we have a 28,000. So out of this 28, we have to get the fraction that we need only 50,000. So 45 is already there. To achieve that 50,000, we need 5,000 more. So 5,000 divided by this fraction. So it is answer is approximately like a 0.18. So 1 to 2.18. So the 2.18 here is what is the total time period what they are getting to achieve the 50,000. So the payback period for this project is 2.18 year. On the other hand, if we look at that one, so the first year, how much is the cumulative inflow? 25,000. Next year, it is 50,000. Now, because this amount is exactly the same So no need to go for this further calculation or the calculation of refraction means what? So in year one and year two. So for this project, the time period, the payback period is how much? This is what? This is the payback period. So the payback period for the project A is 2 year and for project B it is 2.1 year. So now this is the decision which the company has to make that either project A or the investment A is better or the investment B is better. So now we have to see what they are investing is 50,000 and they are getting this back in a 2 years. And here their same investment of 50,000, but they are getting this back in how many years? In 2.18 year. So obviously, this 2 year is better, or simply we can say the project E is better for the company because it has a lesser payback period. So the investment is coming back to them in a less time period. So it is 2 year, it is 2.18 year. So the better is the lesser time period. So within 2 years, they're getting the original amount back. So this is called the payback period. So for this purpose, simply whatsoever here is there, 2 is obviously lesser than 2.18. So what we will select, whatever is the lower is best for the company because in the lesser time period they are receiving their money back. I hope you have understood the concept, but still if you have any confusion, if you have any doubt, you can ask me in the comment section. Thank you. Bye.